Cryptoactives and the long-term golden rule. We all know that investments must be guided by the rule of waiting for long-term results. One of the reasons is that most people do not have the time or technical conditions to value assets in the short term, as they would possibly make bad deals. Calculations show that among investors who ended the first year at a loss, two-thirds would reach the end of the fifth year with at least triple the initial value. The idea that assets with greater risk and volatility, such as shares traded on the stock exchange, require investors to look at the long term is already widespread. This group also includes cryptocurrencies, such as Bitcoin. If the risks of investing in cryptocurrencies thinking about the short term are high, as explained by João Marco Braga da Cunha, portfolio manager at Hashdex, the opposite is also true. The prospects for a good return grow considerably with the maintenance of the asset in the portfolio for longer time. These are assets that require a long-term vision. If anyone thinks about buying cryptoactives thinking about months, I advise against it. They are not indicated because they have adverse shocks and volatility that impact the current price, comments Braga. The Hashdex manager, which has cryptoactive investment funds for various audiences, explains that there are two components that determine the probability distribution of obtaining a positive return on the investment. The first is the expected return or the return trend. The second is asset volatility around the trend. It sounds very complicated, but it's relatively simple. When we combine the two factors in different terms, the longer the investment, the greater the probability of gain. This is because the effect of volatility on the asset price decreases over time, explains Braga. Here the fear factor can also be minimized. When there is emotion, there is usually loss. In the calculations made by the economist based on a series of cryptoactive prices, if the investor focuses on the long term, keeping the invested resources for 5 years, the probability of more than doubling the capital reaches 88.8%, while the chances of doubling the invested capital in just 1 month is 0.3%. The same happens when the analysis projects the probability of loss of invested capital. In a month, the probability of losing part of the value reaches 41.1%. It drops to 30.8% in 6 months and drops to just 5.6% in 5 years. In Hashdex's probability calculations, among investors who ended the first year at a loss, two-thirds would make it to the end of the 5th year with at least triple their initial value. Furthermore, 54% of those who lost more than half of what they invested in the first year would have doubled their initial investment 4 years later. In addition to understanding the importance of investing in Bitcoin thinking in the long term, the Hashdex manager also suggests that investors define their profile and, therefore, the percentage of the portfolio that can invest in risky assets. This prevents the investor from having to withdraw funds ahead of time, which can occur at a time of decline and generate losses, comments Braga. Even a bolder risk profile should not exceed 1 digit of cryptoactives in the portfolio. The more conservative ones might stay at 2% or 3% at most, making the position of the digital currency in the portfolio comfortable, able to absorb occasional downward movements. Hashdex has been expanding its options of available products, thus meeting not only a growing demand for investments in cryptoactives, but also the different profiles of customers looking for the product. The company already had on the shelf the multi-market products Hashdex 20 Nasdaq Crypto Index, Hashdex 40 Nasdaq and Hashdex 100 Nasdaq Crypto Index. The difference between the funds is the percentage for cryptoactives, 20%, 40% and 100%, and the target audience. In the fund with the lowest exposure to crypto, 20%, the general public has access with an investment starting at 500 Brazilian reals. The other two are aimed at qualified investors, explains Braga. Last October, the manager launched 2 new funds also aimed at the qualified public. The new funds created by the company are Hashdex Bitcoin Full 100, with all equity invested in Bitcoin, and Hashdex Gold Bitcoin Risk Parity, which uses the risk parity strategy, investing 50% of its equity in gold risk and 50% in Bitcoin risk. With the new releases, we now have a complete grid aimed at investors looking for cryptoactives. New launches are products with greater risk, and for the qualified public, which in theory understands volatility better. As the funds have not yet faced any turbulence, we do not yet know how this public will behave. The rule is the same. The longer the investment period, the greater the probability of gain, remembers Braga.